So to start off with the required, we're asked to prepare the journal entries for the above transaction for the year ended 31 December 2017 and 31 December 2018. Okay, so this question is coming from your additional questions, which are on the on the MyUnisa platform. So under the additional resources. Okay, so you've got I think it's 18 additional questions. So this is question 17 coming from there. Okay. I've also attached it on my website. So this will be for ease of reference in case you just want to try it on your own. Okay. But yeah, we'll just get right into it. On 1 January 2017, Goods for Mahala Ltd sold a product to a customer on credit for 10,000 Rand with a settlement condition of full payment on 31 December 2018. Goods for Mahala Limited's incremental borrowing rate is 8% per annum. And then Goods for Mahala has determined that the customer's credit risk is 12% per annum, which is a market rate. And then you can assume that this transaction has a financing component that is significant. Okay, so from doing this module or this learning unit of revenue, one thing that you would have learned is that there's a 5-step process, right, for revenue recognition. Okay. So, the core objective of revenue is to recognize revenue in a manner that depicts the transfer of promised goods and services and not merely when the cash has been received. So what you need to know about that is that, you recognize revenue based on what you have done as like a service provider. Okay. So they've broken it down into 5 different steps, right? So in our context here at very high level, the step 1 would be to identify the contract. Okay. So in this case, we know that we sold a product to a customer and they will pay us in 2 years' time. Okay. So, that is the agreement. We give them the product, they give us the money at a very high level. Okay. Then step 2 is identifying each promise in the contract as a performance obligation. Okay. So the performance obligations is what needs to be fulfilled for you to be able to recognize the revenue. Okay. So I mean, it does go into detail with the requirements of a performance obligation, and you can read that in the summaries that I've put under my module, so I cover that quite in detail over there. But for our purposes, we know that we promise to essentially give a product to a customer, and that is the performance obligation that we have, and then step 3 would be to determine the transaction price. Okay. And this is largely where the focus is in terms of this question, right? It's more in step 3, which is determining the transaction price. And there's a couple of principles that you need to know from there. Okay. So, the good thing about these revenue questions is that you always, from like practicing questions and understanding, you can sort of see what it is that they're trying to test, be it, step 1, step 2, step 3, step 4, step 5, So, I mean, when they start talking transaction price and significant financing components, you know that you're dealing with step 3. If there is like multiple performance obligations, and you've got a transaction price that you need to allocate to those, then they're testing step 4, and then, if it's something that you need to decide on in terms of it being, for example, whether you're recognizing revenue at a point in time or over time, then you're in step 5. Okay. So the focus of our question here is in step 3. Okay. And with step 3, when you determine the transaction price, okay, one of the things that you need to consider is if there is a significant financing component. Okay, so with a significant financing component, right? If the difference between when you're receiving or when you're giving the product over to the customer and when you're receiving the money for the product, right? If that, as a practical expedient, if that period is over 12 months, then you typically have a significant financing component. Sometimes the question will explicitly state, that you have a significant financing component, as they have done in this case. So you know that you need to make an adjustment for time value of money, right? So how does that work? Okay, means that you have to basically ask yourself, what would the customer pay for the product, had they paid cash today. And that is obviously different to the amount of money that like the person would pay in a year's time or in 2 years' time in our instance. Okay. Um, you know that 10 Rand today is not 10 Rand in 2 years' time. I mean, it's gonna be worth like much less, or you will get um, less products for it. So that's because of inflation and all of that stuff, you know what I mean? So in our case, it's the time value of money. And in that principle, okay, you see these two interest rates that they gave you there, all right? Um, and you need to know which one you're going to use to be able to determine this transaction price. And it's always going to be the one that reflects the customer's credit risk, okay? Um, the incremental borrowing rate of the company is not the one that you will use, because the standard requires you to use a discount rate that reflects the customer's credit risk. Okay. So we know that the period in is 2 years. Okay. You're going to get the payment in 2 years' time, like it says in the question, the 10,000, right? Then the future value will be 10,000 Rand. Okay. And just as we said now, the discount rate that we're going to use will be the one that reflects the customer's credit risk, which is 12%. Okay. And then we need to work out our present value. How much would the customer have paid had this been a cash transaction? How much is that 10,000 Rand worth today? Okay. So then we'll say the present value, the rate we've got these 12%. Then the period is, okay, no, we don't have a payment. So the period is 2 years. We don't have the payment. Then the future value is, see, there is 10,000 Rand. Okay. And that brings us to 7,972. Okay. So we can go ahead, start with the journals of 2017. All right. So we've got trade receivables. All right. Trade receivables because we're not getting cash, right? It's a receivable. We're going to still receive the money from the customer. Okay. And that trade receivable will amount to 7,000 Rand, 7.9. Okay. Then we recognize revenue for that sale. Okay. It's the first journal we've got over there, right? So now there is the unwinding of the interest, okay, as a result of the time value of money, okay. So now, because there is this financing component, there will be finance income, right? So again, we recognize the trade receivables because we're not receiving this at this point in time, and that will be this present value multiplied by the discount rate. Okay. And then that will be classified under finance income. Right. So this amount will be based on what is outstanding at the point in time for the period, at the beginning of the period. Okay. So now if we have to recognize the transactions for the following year, okay, we know that it's again trade receivables. Okay, and like we said, this will be based on the amount outstanding at the beginning of the year. Okay, then we multiply that by the 12%. Multiply that balance outstanding at the beginning of the period with the 12%. Okay, then we've got again finance income. Yeah, which will be the same amount. Right. So then we get to the end of the year, 31 December 2018, and we have to then recognize the actual payment, right? So that will be bank, right? We know that the customer gives us 10,000 Rand. Customer gives us 10,000 Rand. And then we recognize the trade. We de-recognize the trade receivable. Because now we've received our payment in full. So we no longer have a receivable. And if you look at it, right, the amount of the receivable is equal to all the receivables that we've been recognizing over the past 2 years. And that gives us 10,000 Rand. Okay. So we've got the cash, de-recognize the receivable, then we're done with that. Okay. Right, guys. So if there's any questions, let's just make sure that we put it up in the discussion forum. Any question relating to this. And yeah, all the best for the rest of the tests and the exams. Thank you.